All right, scholars, when we start looking at financial statement transactions, it's just a single transaction with another company that's located in another country, and we've agreed to allow them to pay us in their currency. So we've shipped goods to them, and then ultimately they will pay us in their currency, and we take it and then we convert it to our currency, which for our example will be the US dollar. So let's go through some of the facts associated with this one. Little Cabbage is an American-based restaurant that prides itself on serving authentic French cuisine. For the company's signature dish, chicken with trifle cream sauce, Little Cabbage orders trifles from Les Grands Truffles, a French-based truffle company supplier. Little Cabbage has no ownership interest in Les Grands Truffles and agrees to pay for truffles in the euro. On December 6th of year one, Little Cabbage purchases 250 units of truffles at the euro 250 euros. On that date, the spot rate is $1.11 for a euro. Little Cabbage pays the bill in full in March. What does that mean? That means on December 31st, you have to convert what the exchange rate would be from the date that the transaction started to the date of December 31st, and any adjustment runs through the income statement. And then when you ultimately resolve it on the pay date of March 15th, you then compare what you had as of December 31st to what you actually get on March 15th, and any difference is a gain or loss as well. So on December 31st, the spot rate was 91 cents for every euro. What amount should Little Cabbage report as a foreign currency transaction gain or loss in its income statement for the year ended December 31st, year one? So what we're going to do is we're going to take a look at this as we go through the solution. So let's go through the computations now. On December 6th, the date that we actually ordered the items, the liability denominated in dollars would be $277.50. That was calculated as the 250 units at $1.11. So there's the $277.50. All right, that's going to be a debit to purchases / inventory and a credit to accounts payable. Now, on December 31st, this liability is still outstanding, but we have to make sure that we adjust it to the current spot rate. So therefore, we're going to take the same 250 and we're going to multiply it times only 91 cents for every euro. Therefore, now there's a difference. We're going to have to pay $50 less in order to ultimately do it. So that's actually going to be a gain of $50 in that case. All right, then we continue on. When the liability is settled on March 15th, the exchange rate is now $1.05 for every euro. And therefore, we have a $35 more we have to pay than we projected at December 31st. That means that we're now at $262.50. So therefore, the difference between those two is we're going to pay $35 more than we had to at the difference at the other period of time. Note that there is an actual net gain of $15. The $50 that we saved between the purchase date and December 31st, that was the $277.50 versus the $227.50. That $50 is a savings of because we're paying less to get the euros, to buy euros and then pay them off. And then we wind up losing some money. We wind up losing $35 because we go to $262.50 in US dollars to get the correct amount of euros. But the net of the transaction will be $15. So our takeaways: foreign currency transactions. A transaction with a foreign entity denominated in that is marked to market each period. And foreign currency translation rate is where you convert the entire financial statement. And we're going to look at that when we go to our next skills practice.